Imagine a guy named Marcus, 34 years old, software engineer, decent salary. He's been investing for 8 years. His portfolio just crossed $200,000 last month. His contributions over those 8 years, about 90,000 total. The other 110,000, that showed up without him lifting a finger. Now imagine Marcus in year 2, he'd put in $20,000. His portfolio was worth about $18,500. He'd lost money. The S&P 500 had a rough stretch. His coworker told him to cash out, wait for things to stabilize. He didn't. Good call. Now picture someone who did cash out. Let's call her Denise. Same age, same salary, same starting point. She pulled her money in March of 2020 after watching her portfolio drop 30% in 3 weeks. She told herself she'd get back in when things made sense again. She's still waiting. Her portfolio today? About $67,000. The difference between Marcus and Denise isn't income, it isn't intelligence, it isn't even investment selection. It's that Marcus understood something Denise didn't. Wealth doesn't grow in a straight line. It grows in a curve. And that curve has 3 specific tipping points where the math completely changes. Here's the question that separates people who build real wealth from everyone else. At exactly what dollar amount does your portfolio start making more money per year than you're putting into it? And what happens after that? I'm going to show you the 3 tipping points that change everything about how wealth compounds. Not motivation, not mindset fluff. The actual math with real numbers pulled from SEC filings, Federal Reserve data, and historical market returns. By the end of this, you'll know exactly where you are on the curve and what happens at each level. No guesswork, no guru nonsense. Just a boring, powerful truth that most people never sit down long enough to understand. Before we dive in, I built something. It's a free early retirement calculator based on the same logic BlackRock and Vanguard use for their institutional clients. Nothing to buy, just put in your numbers and it spits out your 3 tipping point dates. Link in the description, email required only because I update it quarterly when new Fed data drops. Use it, don't use it, but at least understand the math underneath it. All right, let's talk about the curve. Most people think about wealth linearly. You save $10,000 a year. After 10 years, you have $100,000. Makes sense. It's also completely wrong. And that linear thinking is why most people dramatically underestimate what's possible. Wealth grows exponentially, which means it accelerates as it gets bigger. But here's the thing nobody explains clearly. That acceleration isn't smooth. It happens in 3 distinct phases, and each phase has a tipping point where the rules fundamentally shift. Let me paint the picture with real numbers. According to the Federal Reserve's Survey of Consumer Finances, median household income in the United States sits around $83,700. Median net worth for someone under 35, about $39,000. And the personal savings rate nationally hovers around 4%. These are the starting coordinates. Most Americans are saving roughly $3,000 a year. At that pace, linear thinking says you'd hit $100,000 in about 33 years. But compounding doesn't work linearly. And that's either the best news or the most frustrating news you'll ever hear, depending on where you are on the curve. The first tipping point is the crossover. This is the moment when your investment returns in a single year exceed the amount you contribute that year. It sounds small, it isn't. This is where the curve stops feeling like a grind and starts feeling like something's happening. Let's do the math. Say you're saving $10,000 a year. Aggressive, but achievable for a lot of people watching this. You're invested in a broad market index fund, historically returning about 10% annually before inflation. When does 10% of your portfolio exceed the $10,000 you're adding each year? When your portfolio hits $100,000. At that point, your portfolio generates $10,000 in growth without you contributing a penny. You've matched your own annual effort with pure mathematical returns. That's tipping point 1. Charlie Munger, Warren Buffett's longtime business partner, famously said that the first $100,000 is the hardest. He wasn't being poetic, he was being mathematical. Let me show you why. Starting from zero, saving $10,000 a year at 10% returns, it takes roughly 7 to 8 years to hit that first $100,000. That's a long time. You're grinding away year after year, watching numbers that feel almost meaningless. 20,000, 35,000, $62,000. Progress feels glacial. And here's the psychological trap. In roughly 1 out of every 3 years, the market goes negative. So somewhere in that 7-year stretch, you're probably going to see your portfolio drop, maybe significantly. And that's exactly when most people quit. They look at their $60,000 portfolio that's suddenly worth $49,000, and they think, this isn't working. They cash out. They wait. They try to time the re-entry. And in doing so, they reset their curve back to zero. They don't realize that those 7 years of grinding weren't just about the money accumulated. They were about positioning for the acceleration phase. Because here's where it gets interesting. Going from $0 to $100,000 takes 7 to 8 years of consistent contribution. Going from $100,000 to $200,000, about 5 years, same contribution rate, same return rate, but the math has shifted. Your portfolio is now generating enough returns that it's doing heavy lifting alongside your contributions. $200,000 to $400,000, roughly 4.5 years. The timelines compress as the portfolio grows. Not because you're working harder, but because the math is working differently. But here's what nobody tells you about this phase. The crossover point, where your returns exceed your contributions. It happens exactly once. You cross it and you never go back. The portfolio is now fundamentally different than it was before. You've moved from the accumulation phase, where progress is entirely dependent on your labor, into the acceleration phase, where your past work starts paying you alongside your present work. It's like the moment a rocket clears the thickest part of the atmosphere. The fuel burn rate is the same, but suddenly everything gets easier. Now, I should pause here and address something. When I say 10% returns, I'm not promising anything. Historical returns for the S&P 500 from 1957 through 2024 average about 10.13% annually before inflation. But here's the critical context. That average includes some horrific years. 1973 and 74 back-to-back negative years totaling over 37% losses. 2008 down 38%. March of 2020 down 34% in weeks. The average is 10%. The experience is chaos. And that chaos is exactly why most people never hit tipping point 1. They quit during chaos. They sell during chaos. They wait for clarity during chaos. Clarity, by the way, is the most expensive word in investing. By the time there's clarity, prices have already recovered. You sold at the bottom and bought back at the top. That's not a market problem. That's a brain problem. Let me tell you about a guy I knew. We'll call him Steven. Smart guy. Engineering manager, income around $140,000 a year. He started investing in 2016, putting away about $15,000 a year. By early 2020, his portfolio was worth about $87,000. Then March happened. He watched his portfolio drop to $58,000 in 3 weeks. His father-in-law told him to preserve capital. His wife was nervous. He sold everything on March 23, 2020. If you follow markets, you know what happened next. The market bottomed that day. Within 6 months, his old portfolio would have been worth $112,000. Within 18 months, it would have hit $152,000. He got back in around January of 2021, but he'd missed the recovery and bought back in at higher prices. As of early 2026, he's still not crossed the $100,000 threshold. Same income, same contribution rate, 6 years behind where he should be. The portfolio didn't fail him. His psychology did. I see this constantly. The people who reach tipping point 1 aren't the smartest investors or the highest earners. They're the people who understand that bad years aren't obstacles to compounding. They're the price of admission. You don't get the 10% average without accepting the negative years. And the negative years are precisely when the next decade's returns are being set up. When stocks drop, future expected returns go up. When stocks soar, future expected returns go down. It's counterintuitive. It feels wrong, but it's the mathematical reality. All right, let's do some escalation cycles. I'm gonna walk through concrete scenarios, and I want you to notice how the numbers start to behave strangely as we move up the curve. Escalation cycle 1, you're at tipping point 1. Portfolio, $100,000. Annual contribution, $10,000. Historical return, 10%. Year 1, your portfolio grows by $10,000 from returns, and you add $10,000 from contributions. Total growth, $20,000. Portfolio at year end, $120,000. Year 2, same assumptions. Returns, $12,000. Contribution, $10,000. Total growth, $22,000. Portfolio, $142,000. Already, your returns are matching and then exceeding your contributions. You're no longer the only one building your wealth. Your wealth is building your wealth. But watch what happens when we escalate. Escalation cycle 2. Same person, 5 years later. Portfolio is now $250,000. Same 10% return assumption, same $10,000 annual contribution. Year 1, returns generate $25,000. Contribution adds $10,000. Total growth, $35,000. Your portfolio just grew more than 3 times your annual contribution in a single year. At this point, if you stopped contributing entirely, your portfolio would still grow more annually than you were adding when you started. The math has fundamentally shifted. The curve is now steeper. The snowball is now rolling downhill on its own momentum. Here's where I normally say something motivational, but that's not why we're here. The point isn't that compounding is magical. The point is that compounding is mathematical. And mathematics doesn't care about your feelings. It doesn't care that year 3 felt slow. It doesn't care that you had to replace your HVAC system in year 5 and couldn't contribute. The math just compounds on whatever number is there. That's either liberating or terrifying, depending on your perspective. Quick comedic sidebar. You know those financial gurus who post charts showing what if you'd invested $1 in Coca-Cola in 1919? And it's always some insane number like $9 million? They never show the reverse. What if you'd invested in one of the 300 companies that were removed from the S&P 500 since 1990? What if you'd picked General Motors before bankruptcy? Eastman Kodak before digital cameras killed film? The survivorship bias in those charts is doing heavy lifting. But here's the thing. You don't need to pick winners. You just need to own the entire field. Total market index funds capture the winners automatically while diluting the losers into irrelevance. The secret isn't stock picking. It's patience and broad exposure. But be patient and buy everything doesn't sell courses, so you get sold complexity instead. That was a free preview of the kind of stuff I share every week. If you're getting value from this, the algorithm apparently likes engagement, so hit subscribe and the like button. It costs you nothing and helps the channel reach people who are tired of get-rich-quick nonsense. Back to the math. So we've established tipping point 1, the crossover. Your returns exceed your contributions. But here's what I need you to understand about this phase. It's fragile. The period between $100,000 and about $300,000 is psychologically the most dangerous zone on the curve. Why? Because you have enough money that losses feel significant, but not enough money that losses feel survivable. Let me be specific. At $100,000, a 30% market drop erases $30,000. That feels devastating. It's 3 years of contributions, gone in months. Your brain screams at you to stop the bleeding. But here's the reality. If you hold and markets recover, that $30,000 paper loss becomes irrelevant. If you sell, it becomes a permanent loss. You locked in the decline. You turned a temporary fluctuation into realized damage. At $300,000, that same 30% drop erases $90,000. Sounds worse. But here's the thing. By the time you're at $300,000, you've already lived through multiple market cycles. You've seen your portfolio drop and recover. You've developed, hopefully, some psychological immunity to volatility. The dollar amounts are higher, but your relationship to them is different. You understand that the portfolio isn't a bank account. It's a living thing that breathes. It expands and contracts, but over time, it expands more than it contracts. The people who make it through this danger zone share one trait. They stopped looking. Not literally, but emotionally. They set up automatic contributions, automatic rebalancing, and they go live their lives. They check their portfolio quarterly at most, some check annually. The people who check daily, who refresh their brokerage app during market hours, who read every headline about rate hikes and earnings misses and geopolitical tension. They're the ones who make emotional decisions. And emotional decisions are almost always the wrong decisions. I've been investing for over a decade now, multiple six figures deployed, and I can count on one hand the number of times I've logged into my brokerage account this year. Not because I don't care, because I care enough to know that checking doesn't change anything. The stocks don't know I'm watching, the market doesn't care about my feelings. The math compounds whether I'm watching or not. And if watching makes me more likely to interfere with the math, then watching is a liability. So I don't. This is the unglamorous reality of tipping point one. It's not about picking the perfect investment. It's not about timing the market. It's about understanding that the first $100,000 is the hardest $100,000 you'll ever accumulate. And it's hard specifically because the progress feels slow while the risks feel immediate. You're in the thick of the atmosphere. The rocket is burning fuel like crazy and barely moving. Every instinct tells you something's wrong. Nothing's wrong. That's just how rockets work. Let me give you some specific data points on the time compression I mentioned earlier. These are rough averages based on historical returns, so don't hold me to the exact month. But the pattern is consistent, starting from zero, contributing $10,000 annually at 10% returns. $0 to $100,000, approximately 7 to 8 years. $100,000 to $200,000, approximately 5 years. $200,000 to $400,000, approximately 4 years. $400,000 to $800,000, approximately 3.5 years. Notice what's happening. Each doubling takes less time than the previous doubling, not because you're contributing more, because the portfolio's own returns are now contributing alongside you. The snowball is picking up snow as it rolls. Now, there's an objection I should address. But Tom, what if returns aren't 10%? What if we have a lost decade like the 2000s? Valid question. From 2000 through 2009, the S&P 500 had a total return of roughly -9%, negative, over 10 years. If you started investing in 2000 and contributed consistently through that decade, you'd have ended with less money than you contributed in nominal terms. Brutal. But here's the critical context. If you continued contributing through that lost decade and held through the recovery, your returns from 2010 through 2024 would have been extraordinary. The S&P returned over 260% from 2010 through 2024. The lost decade set up the found decade. Low prices during the lost decade meant you were buying shares cheap. When prices eventually recovered, you owned more shares purchased at lower costs. This is the counterintuitive reality that most investors never internalize. Bad markets for returns are good markets for accumulation, if you have time and patience. The worst thing that can happen to a young investor is a roaring bull market. You're buying expensive shares. You're feeling smart while accumulating less ownership. The best thing that can happen is a flat or down market while you're in the accumulation phase. You're buying cheap, you're accumulating more shares per dollar. The recovery will reward that accumulation enormously. I'm not rooting for market crashes. I'm describing how the math works. The people who reached tipping point one fastest in recent decades were often the ones who stayed consistent through 2008 and March of 2020. They didn't just hold, they kept buying. They bought when it felt stupid to buy. They bought when everyone on financial news was predicting the end of capitalism. They bought when their own instincts were screaming at them to wait for stability. And when the recovery came, their portfolios exploded upward because they'd accumulated shares at bargain prices. That's the other side of the psychological trap. Not just panic selling, but panic freezing. Failing to buy during downturns because it feels risky, when mathematically, it's the least risky time to buy. The risk isn't in buying during crashes. The risk is in needing the money during crashes. If your time horizon is long, crashes are opportunities. If your time horizon is short, crashes are threats. Know which one you are, plan accordingly. Now let me show you where this is all heading. We've covered tipping point one, the crossover, but there's a second tipping point that's even more psychologically significant. This is the point where your annual investment returns match or exceed your annual salary. Think about that for a second. Your portfolio generates a year's worth of your labor income without you working a single day. That's not just financial progress. That's an identity shift. You start asking different questions. Why am I trading time for money? Becomes more interesting than how do I earn more money? The game changes. At median household income of $83,700, assuming 10% returns, tipping point 2 happens around $837,000. At that level, your portfolio generates roughly $83,000 in average annual growth. Your money is now earning what you earn, and that creates options that didn't exist before. You can negotiate differently at work because you don't need the job the same way. You can take risks you couldn't take when you were entirely dependent on labor income. You can think about time differently because you've decoupled your survival from your hours. But I'm getting ahead of myself. That's tipping point 2, and we're going to go deep on it. The reason I'm mentioning it now is because I want you to see the trajectory. Tipping point 1 is the crossover. Tipping point 2 is the replacement. Tipping point 3, which we'll cover after that, is the freedom threshold, where your portfolio can theoretically sustain you indefinitely through safe withdrawal rates. Each tipping point unlocks a different relationship with money, work, and time. Each one changes the questions you ask and the decisions you make. Here's what I want you to take away from this first section. The first $100,000 is the hardest. Not because I said so, not because Charlie Munger said so, because the math says so. The crossover point, where your returns exceed your contributions, is a one-time threshold. You cross it once, and the curve changes forever. The danger zone between $100,000 and $300,000 is where most people psychologically fail, even though mathematically they're making progress. And the people who make it through that danger zone don't make it because they're smarter or luckier. They make it because they understand that volatility isn't risk. It's the price of the returns. Your portfolio right now is somewhere on this curve. Maybe you're at the beginning, grinding toward that first $100,000. Maybe you've crossed tipping point 1 and you're in the acceleration zone. Maybe you're approaching tipping point 2 and starting to feel the weirdness of your money out-earning your labor. Wherever you are, the math is the same. The curve is the same. The tipping points are fixed. The only variable is whether you stay on the curve long enough to cross them. Next, we're going to dive into tipping point 2. I'll show you the exact numbers where investment returns match salary, the psychological shifts that happen when you cross that threshold, and why this phase creates a completely different kind of addiction. The acceleration doesn't stop at the crossover. It intensifies. And that intensity brings its own challenges. Let's get into it. Tipping point 2, the replacement threshold. Here's where things get genuinely weird. You've crossed the first tipping point. Your returns are exceeding your contributions. The snowball is rolling, but you're still showing up to work. You're still trading time for money. And then one year, you run the numbers and you realize something unsettling. Your portfolio grew by more than your salary. Your money made more money than you did. Let's do the math. Median household income in the United States sits at $83,700. Assuming 10% average annual returns, your portfolio needs to hit approximately $837,000 before it generates that same amount in a single year. At that point, your investments are earning what you're earning. Every 12 months, your portfolio produces the equivalent of a full-time median salary without you lifting a finger, commuting, attending meetings, or dealing with a boss. The psychological shift here is profound and under-discussed. Before this threshold, the dominant question in your financial life is, how do I earn more? You're focused on salary negotiation, side hustles, career advancement, all valid pursuits. But after crossing tipping point 2, a different question starts to surface. Why am I trading time for money? Not because you're lazy, because you've become numerically aware that your time might be worth more elsewhere. This doesn't mean you quit your job. Most people who cross this threshold don't. But it changes the power dynamic. You negotiate differently when you don't need the job. You take risks when failure doesn't threaten survival. You say no to requests that don't serve you. The portfolio becomes a negotiating partner. It has your back in a way that no emergency fund ever could. But here's what's fascinating about this phase. Great years in the market can push you across this threshold faster than you expect. Let's look at recent history. In 2023, the S&P 500 returned over 26%. In 2024, it returned over 25%. Back-to-back exceptional years. If you had a $400,000 portfolio at the start of 2023, it grew by over $100,000 in those 2 years alone. More growth than most Americans earn in 2 years of full-time work. And that's at $400,000, not even close to the full replacement threshold. This is the addictive nature of tipping point 2. Every extra year you stay invested, the numbers stop adding and start multiplying. Your contributions become almost irrelevant compared to what the portfolio generates on its own. You could stop contributing entirely and still see annual growth that exceeds most people's salaries. Let me give you a concrete escalation. Escalation cycle 3. You've crossed tipping point 1. Portfolio is now $500,000. You're still contributing $10,000 annually, but honestly, it almost doesn't matter anymore. At 10% returns, your portfolio generates $50,000 a year on average. Your contribution is 20% of that. Nice, but not the main event. Now fast forward 3 years, same contributions, same returns, portfolio hits $700,000, annual growth, $70,000. Your contribution is now 14% of total growth. Fast forward another 2 years, portfolio crosses $1 million. Annual growth, $100,000. Your contribution is now 10% of total growth. The portfolio is doing 90% of the work. You're almost vestigial to your own wealth building at this point. And here's the part that messes with people. The gap between your work income and your portfolio growth starts to widen. If you're earning $100,000 a year and your portfolio is growing by $150,000, you start to do the mental math. Every year I work, I earn $100,000. Every year I don't touch my portfolio, it earns $150,000. Why am I working again? This creates a strange psychological pressure. Some people feel guilt. They feel like they're not earning their wealth anymore. Others feel resentment toward their job, which now feels inefficient compared to just letting the portfolio run. Still others feel anxiety, waiting for the other shoe to drop, convinced this can't possibly last. All of these reactions are normal. They're also all missing the point. The portfolio isn't luck. It's the accumulated result of years of contributions and patience. You earned this. You just earned it in the past rather than the present. Let me walk you through a complete mini case study. Someone hitting all 3 tipping points over time with real numbers. Meet James, 29 years old in 2016, software developer, income of $75,000. He starts investing that year, contributing $15,000 annually, average annual return of 10%. Let's track his journey. Year 1, 2016. Contribution, $15,000. Return, minimal. He started mid-year. Portfolio, roughly $16,000. Feels like nothing. Year 3, 2018. Portfolio, roughly $52,000. Market volatility that year. Feels slow. Year 5, 2020. Portfolio, roughly $93,000. Then March happens. Portfolio drops to $68,000. James holds, keeps contributing. Year 6, 2021. Portfolio recovers and then some. Crosses $100,000 for the first time. Tipping point 1 achieved. Took about 5.5 years. Year 8, 2023. Portfolio, roughly $200,000. Returns that year, $52,000 with the strong market. His returns now exceed his annual contribution by more than 3 times. Year 11, 2026. James is 39 years old. Portfolio, approximately $480,000. Annual growth, on average, $48,000. He's still contributing $15,000 a year, but the portfolio is now generating more than 3 times his contribution annually. Project forward. By age 45, assuming he stays consistent, James crosses $800,000. His portfolio is now generating more growth annually than most Americans earn in salary. He's approaching tipping point 2. By age 50, he crosses $1.2 million. He's now in spitting distance of financial independence. And here's the key insight. Most of the heavy lifting happened in the middle years, not the early years. The first $100,000 was the grind. The middle $300,000 was the acceleration. The final stretch to financial independence is almost entirely the portfolio running on its own momentum. This is why I keep emphasizing tipping points 1 and 2. The distance from zero to financial independence is covered primarily by those first two thresholds. Once you cross them, the rest is almost inevitable if you don't interfere. The math does the work. Now let's talk about tipping point 3, financial independence. This is the threshold where your portfolio can theoretically sustain you indefinitely without additional income. The math here is based on what's called the 4% rule, derived from the Trinity study and subsequent research. The rule states that if you withdraw 4% of your portfolio in year 1 of retirement and adjust that amount for inflation each subsequent year, historically, that portfolio would have survived at least 30 years in over 95% of historical scenarios. It's not perfect, it's not a guarantee, but it's a useful framework for planning. To calculate your financial independence number, you take your annual expenses and multiply by 25. Why 25? Because 25 times your expenses equals a portfolio that allows 4% withdrawals to match those expenses. Simple math, profound implications. Let's run some numbers. If your annual expenses are $60,000, your financial independence number is $1.5 million. At $80,000 in annual expenses, you need $2 million. At $100,000 in annual expenses, you need $2.5 million. The number scales linearly with your lifestyle. This is why reducing expenses is mathematically equivalent to increasing your portfolio. Every dollar you don't need to spend is a dollar your portfolio doesn't have to generate. Cut your expenses by $20,000 a year, and you've just reduced your financial independence number by $500,000. But here's what most people miss about tipping point 3. It's not a cliff you fall off. It's a zone you enter. You don't wake up one day and suddenly have zero financial concerns. You wake up and realize that your relationship with work has fundamentally changed. You have options. You can continue working because you want to, not because you have to. You can take a lower paying job that's more meaningful. You can start a business without worrying about feeding your family during the lean years. You can retire early, or you can keep working and watch your portfolio grow even faster because you're not withdrawing from it. Escalation Cycle 4, the median versus average net worth gap. According to Federal Reserve data, for Americans aged 55 to 64, median net worth is approximately $364,500. Average net worth? Over $1.5 million. That's a gap of more than $1.1 million. How is that possible? The average is pulled up dramatically by people who let compounding work. They crossed tipping points 1 and 2 early, and then they stayed on the curve. The median, by contrast, represents the person in the middle, half above, half below. And the person in the middle, the typical 59-year-old American, has a net worth that's less than a quarter of the average. This isn't about inequality, by the way. That's a separate conversation. This is about behavior. The people who pull up the average aren't necessarily billionaires. They're people who saved consistently, invested in broad market index funds, and didn't cash out during downturns. They understood the curve. The median person, more often than not, got spooked somewhere along the way, or never started, or started late, or treated investing like gambling, picking individual stocks and losing, or chasing whatever sector was hot and getting burned. The gap between median and average is the cost of impatience, summed up across millions of households. Here's another comedic sidebar. You know who loves to talk about financial independence? People selling courses on financial independence. The math is free. The Trinity study is public. Vanguard's website has retirement calculators. The Federal Reserve publishes data quarterly. Everything you need to know about reaching tipping point 3 is available without spending a dime. But free information doesn't feel valuable. So people pay $2,000 for a course that says spend less than you earn and invest the difference in index funds. That's not education. That's accountability. They're paying someone to make them do what they already know they should do. If that's what it takes, fine. But understand what you're buying. All right, here's the reversal. You think timing the market is the problem. You think if you could just buy at the right moments and sell at the right moments, you'd be fine. Actually, consistency is the problem. The people who fail at building wealth don't fail because they bought at the wrong time. They fail because they didn't keep buying. They bought once watched it drop, panicked, and stopped. Or they bought during a bull market, felt smart, then sold during a bear market and locked in losses. Timing matters far less than time in the market. The difference between someone who invested on the worst possible day each year versus the best possible day each year over 30 years is surprisingly small. The difference between someone who invested consistently for 30 years and someone who stopped and started based on feelings is enormous. The math punishes timing attempts and rewards consistency. This is the opposite of what your brain wants to believe. Your brain wants to think you can outsmart the market. You can't. You can't because you're competing against institutional investors with billion-dollar algorithms, inside information access, and the ability to execute trades in microseconds. You're not going to outsmart them, but you don't have to. You just have to stay on the curve longer than they can. They have quarterly earnings reports and impatient clients. You have time. Use it. Let me return to the question I asked at the beginning. At exactly what dollar amount does your portfolio start making more money per year than you're putting into it? And what happens after that? By now you know the answer. At $10,000 annual contribution and 10% average returns, it happens at $100,000. And after that, everything changes. The math shifts. The psychology shifts. The questions you ask shift. You go from how do I accumulate to how do I not interfere? You go from grinding to accelerating. You go from dependent on labor to where that labor is optional. And then, if you stay on the curve long enough, you cross tipping point 2 and then tipping point 3, and you realize that the whole game was about positioning yourself to let mathematics do what it does. 3 practical takeaways. Specific, not generic. First, calculate your position on the curve. Divide your current portfolio value by your annual contribution amount. If the result is under 10, you're in the grind phase. The portfolio isn't doing much yet. Your job is to keep contributing and ignore the noise. If the result is between 10 and 25, you're in the acceleration zone. Returns are starting to matter more than contributions. Your job is to stay the course and not get clever. If the result is over 25, you're closer than you think. The portfolio is doing heavy lifting. Your job is to protect it from yourself. Second, identify your personal tipping point 2. Take your annual salary or household income and multiply by 10. That's roughly the portfolio level where average returns match your labor income. Write that number down. Look at it occasionally. It's not a magic number. It's just a milestone that changes your relationship with work. Knowing where it is helps you understand why you're doing what you're doing. Third, calculate your financial independence number. Take your annual expenses, not your income, your expenses, and multiply by 25. That's the portfolio size that could theoretically sustain your lifestyle without additional income. If that number seems impossibly far away, good. Now you know the target. If that number seems closer than you expected, also good. You might be further along than you realized. Either way, you have data. Data is better than guessing. Lazy investing built more fortune than crypto memes. I'm not anti-crypto, by the way. I own some. But I don't confuse speculation with investing. The people who got rich on crypto mostly got lucky, and most of them will give it back because they think they're geniuses now. The people who build real wealth do it slowly, boringly, with index funds and patience and the willingness to look stupid during bull markets when everyone else is bragging about their gains. Being boring is an edge. Being patient is an edge. Being willing to do nothing while everyone else is frantically trading is an edge. Those edges compound. The system is designed to make you feel like you're missing out. Financial media makes money from your attention, and fear and greed generate more attention than calm rationality. Brokerages make money from your trading, and frequent trading generates more revenue than patient holding. Influencers make money from your engagement, and hot takes generate more engagement than measured analysis. None of these entities are on your side. They're not evil. They're just responding to their own incentives. Your job is to understand those incentives and not get played by them. Stay on the curve. Trust the math. And when you cross that first tipping point, remember that the hardest part is already behind you. Everything from there is acceleration. The curve doesn't care about your feelings. It just compounds.